welcome. Thank you so much for joining us today for Barry Dunn's quarterly In the Know podcast. This is a series focused on the financial services industry, current trends, and hot topics. My name is David Stone, and as always, I'm joined by Susan Weber. Susan, you want to give an intro to the audience today?
Sure. I'm Susan Weber, 26-year banking veteran turned accountant. No, not really. Consultant. And I help banking clients with all kinds of pain points, getting through them, most especially recently CECL and model validations and things like that. But always happy to be here to talk about banking in general and credit risk and all kinds of topics.
Yeah, great. I know we have a jam-packed session today. We chatted about a lot, and now we're planning session, and now we'll try to translate it for the audience, right?
That's it. We always like to do that, sort of that dry run to make sure we've got, good content for everybody.
So I think today we'll start off kind of as usual with our quarterly banking profile update. So the FDIC just came out with their quarter 4 22 banking profile. So I know we're well into 2023, but probably a good opportunity to do a quick recap. And I should mention our summary is available on the website for download, so certainly check it out. I'm only going to pull out a few of the highlights here today in this podcast. So I know in Q4, really to round out the year, full year net income was above the pre-pandemic average, despite being marginally lower than 2021. So still certainly, all around a great year for community banks on the net income perspective. And, that was largely driven by a, pretty remarkable increase in net interest margins. Mm-hmm. That gap, continued to widen, and I know I ended Q4 at 371 basis points. So net interest margin was 3.71%. And this actually surpassed the pre-pandemic average of 3.63%. And if you look at the graph, and we'll certainly have it in our summary, it's just kind of a crazy spike upwards from what was a downward trend in net interest margin. So quite a change all of a sudden in the interest rate environment, as we're all well aware.
Mm-hmm. Yeah, and it's going to be interesting to see what happens coming into the first quarter. There's a little bit of a delay by the time we release these podcasts and when new information is available. But, we're right at the time of the year where the first quarter results are going to be coming up soon. And we'll be watching those, right? Not only because of the adoption of CECL, which so many institutions have had to do in the first quarter of this year, and seeing just what that is going to look like, right? So we're going to be anticipating all of this ramp up to CECL adoption. We'll be watching to see what actually happens to allowance levels. And it'll be a little interesting too, because so much has been happening in the world and in the markets just this quarter alone. Although I say that almost every quarter, it feels like something, but it really has been quite dramatic in this first quarter. One of the things that I wanted to really bring up is TREP. It's an organization that I've brought up before.
Sure.
They're probably the nation's largest database of securitized mortgages, and they publish a lot of information that's really helpful to institutions. And one of the things that they've been watching is different segments of the commercial real estate and what's been going on with those. And they've been tracking what's been happening with office, right? Office has been talked about ever since the pandemic, what's going to happen with office space and this kind of thing. And office collateralized loans jumped 16% in January to exceed 4% for the first time in 2019. These are workouts, right? Special servicing or workouts. And then they jumped another 10% in February. So we don't know yet what March looks like, but there's definitely some concern that there's some weakening in the office markets. And I think if you think about, regional and midterm banks, you would probably kind of expect them to have a little bit more of those early warning signs. But I think there's some things that even community banks can really do to make sure that they've got a good handle on any sort of office risk that they have. We've got a new article out about that, and so we'll put a link to that in the notes. But generally, I think just having an awareness of what some of those key ratios are, just looking at things like, who you're exposed to. Do you have any concentrations? Can you even identify the office exposures that you have in your portfolio? And is there some higher level analysis that you can do around those? And also, it may be a preventative time, right? You may want to go into offense and have some conversations, some planned conversations with loan officers, especially for your higher balanced office loans, so that you understand, whose contracts may be expiring when, whose leases, that is, may be expiring when, and what some of those key data points are that you're going to really want to assess to make sure that you're going to be on solid footing.
Yeah. And you stole my thunder. I was going to mention. No. I don't mean it that way. But I was going to mention the active communication with loan officers and ultimately with lessors. And I mean, I feel like that's just so critically important right now, because I know just in talking with like my client base, we'll often ask, what are you seeing? Are you seeing people come into the office now? Or are you not? Are you requiring people? And it's really a mixed bag as to what is happening out there in the market. And of course, that has implications for when leases do renew, what these companies are probably going to do. And obviously, that's going to impact the lessor's ability to make those loan payments on office space. So, I think it just makes it that much more critical to have those proactive conversations just to kind of see, where do you expect vacancy rates to be in the next 3 years, 5 years? Are there any tenants that if you were to lose them, it would be detrimental to your ability to repay?
That's exactly it. And I think a lot of times what's really tough is when these things start going, they're pretty fast moving. And a lot of it is anecdotal evidence, right? And we're all busy people. If you don't put a stake in the ground and say, we are intentionally going to have this conversation and we are intentionally going to try to share this information when it becomes available, if you don't have an ongoing pipeline of that, there is nothing wrong with pulling a list of your office portfolio and explaining to people that now is exactly the right time to be having some of these very intentional conversations, weave them into planned meetings. This is the time of the year that people are going to start knocking on doors and, thinking about annual reviews and all kinds of things. So now is exactly the right time to be thinking about what else do you need to know or want to know or should inquire about, and where and who in the organization needs to know that when you roll that up. So there's a real good feeling about the health of that portfolio can be had.
Yeah. And just to add on to that, I mean, another to look in the rearview mirror again, another stat from the quarterly banking profile was that non-current loan rates actually hit another quarterly banking profile record low. Of 44 basis points. So super low. And that's since data collection started in 1984.
That's crazy.
Yeah, it is crazy. And the reason I mention it is because, if you look in the rearview mirror, everything looks pretty calm. But then, we talk about these emerging risks, in office space, and, we'll certainly chat about some other risks here in a moment. But complacency is certainly not the right word, but I think it is easy to kind of get into that groove of, okay, everything's all right. But as we know, things can change super quickly. So I'm glad you bring that up, Susan.
They really can. And, and I think what happens, you get a little out of practice, right? And you kind of forget how many years of goodness we've actually had. I just made that up, goodness, but how many years of stability we've sort of had when you really think about it from that standpoint. It's been a while since it's really been since the last Great Recession that we had to really work out things. Yeah. And when you think about, who may be in your institutions differently today than were there then, they may not just have a solid appreciation for those life lessons that were learned through that last crisis. And, I'm a big believer in an ounce of prevention, right? So let's get in there and make sure that we really know what we think we know.
Yeah, no, great.
So the world is a little bit in flummox. There's been a lot of banking news in the last few weeks, certainly with the bank failures. We can't probably do an In the Know podcast and not at least touch on bank failures and what we think that's going to do to things. So I'll jump in and say I really don't want to talk about what everybody else is talking about with them.
But we have to, right, Susan?
We have to. I know. I mean, what has happened and what that all means, and who knew what, when, and how, and FDIC. We'll let the cards play out, but I do think that there are some things that bankers can be thinking about and be aware of, and some of the things that occur to me are. Obviously there's a heightened focus on liquidity and the matching of your assets and liabilities and what that actually means. I've gotten a few questions to say, does this change anything that we do with our investments relative to CECL? And I would say no. I mean, from the standpoint of this is really around the credit risk involved in those. And so you just need to be really clear on what the rules are for assessing those for AFS and HTM. But really this was really on that matching and that liquidity side. So, from that standpoint, I don't really see it. But what I do think is there's going to be, once everybody sort of comes to grips with, who's at fault and who we want to point a finger at and blame,
sure.
Which I don't love. That's the piece I don't love. Hopefully there'll be some real good conversations happening about what does FDIC insurance look like in the future? Do we need to recalibrate that? What does that look like? This conversation about bailouts and small banks versus big banks. I worry a little bit about the health of the industry with that, but I certainly appreciate all sides of that coin. But I do think that, institutions should be prepared for some increased scrutiny in the short term. I think there's going to be a lot of questions asked, on all sides to just make sure that people have a good understanding of what they have going on. And I think for those institutions that feel very removed from the situations that kind of created this situation, I think I would just encourage you to still pay really close attention to what's happening, because there are definitely lessons learned here. And you might be surprised to find that while the details of it might be different for you, or feel different for you, there are lessons that can be learned here. And certainly some future impact into banking is going to be an outcome of this, whether it's more regulation or more scrutiny or more insurance or more fees or whatever it is, staying abreast of those is really critically important.
Yeah. And I always like to think that with challenges like this also comes opportunity, right? And I think this really is a great opportunity even for maybe community banks specifically to really differentiate themselves from some of those other players out there.
Without a doubt. Without a doubt. No, I don't mean to interrupt you, but absolutely no. Without a doubt. Yeah.
Yeah, because I think for, you and I, Susan, and certainly the audience, we're very well aware of the difference between a community bank, a regional bank, a national bank. But a lot of people, a bank is a bank, right? Like they don't really know what those nuances are. And this really has put the spotlight on the different types of institutions out there. So did want to mention that, I think this does pose itself as hopefully a great opportunity for our listeners.
Absolutely. And I think it's really important that we continue as community bankers to tell our story, right? And I say I can't shake 26 years of being a community banker. I just can't do it. But, I think it's really important that community bankers share their story along these lines. There are, and you saw it, right? Not in the very first few hours, but you saw it as that weekend continued to unfold and we got into Monday and Tuesday, right? The 13th, the 14th. You saw more and more. I did, my LinkedIn feed was full of it. I saw more and more C-suite and presidents of community banks coming out and talking very passionately about what it is that makes community banking special and different, and what that means to their communities and constituencies. And so I find that really helpful. But we should talk about social media a little bit, right? Because gosh darn it. They're just that it's just there is an ugly side to social media that I think it's worth mentioning here, and I know you have some thoughts on that.
Yeah, I know I was listening to a presentation recently, and they brought that up, how we're in a different environment now with social media, and this isn't the first time, of course, that things have gone from 0 to 100 real quickly as a result of social media. There's just so much information out there, whether it be truthful or not. Something kind of catches a wind and it blows into something a lot bigger than what may have otherwise been. And I think, I don't know, there's a lot of different factors that play into this, and I'm not in a position to say, with certainty what did and what didn't cause this. But, I think social media certainly did, to some extent, have an influence on this event, and maybe the trajectory of it as well.
Yeah, I think no doubt for sure it had some sort of impact. And I think that's a real strong lesson for all of us to think about and learn too, how quickly misinformation can be put out there, but also once it matters who says what to whom. And even tenfold, right? Because of the element of social media. And so I think, we like the positive sides of social media where the messages are helpful and positive and good and heartwarming and this kind of thing. But there's this side where, it certainly can go very quickly in the other direction. And it's really hard to retract that or to stop it or to stem that tide. So I think with anything, transparency is helpful. But I also think that, there's a responsibility that comes with that. And I hope that there's some good lessons that come out of it, from that standpoint.
Yeah. And there's a lot to unpack here.
Yeah, we could take days to talk about this topic.
we could. The accountant in me kind of thinks about the accounting side of this too. And, as kind of some background, as I'm working through like accounting standards and reviewing financial statements, I often ask myself, like, what's the purpose of this disclosure, or, why is this presented this way? Just really trying to dig into the why of accounting standards. And every now and then there's events like this that really highlight certain disclosures or information in financial statements that may have taken the back seat, over the last however many years. And I think we certainly saw that recently. There's been a lot of discussion over the accounting for held to maturity securities and if that needs to be revisited. Liquidity disclosures, are those adequate for financial institutions? So I don't know where those conversations are going to head, but it's certainly interesting to think about that and kind of think about the why. Why are we presenting things the way they are, and are changes in order, to better present that information.
Yeah, sometimes these events come along and they remind us of some best practices that we always knew were true, and we just maybe have gotten away from it a little bit, and we go, oh yeah, that makes sense. And then sometimes they highlight where we haven't necessarily calibrated as much as we should have for the times that we're in. And I think this certainly has the possibility of being both at the same time. Like, I think there are some aspects to, without getting too far into it, there may be some aspects of FDIC insurance that just haven't quite kept pace with, who America is today that, is worth discussing. And then there may be some other things that we just need to remind people why these are even in here to begin with. But at the end of the day, regardless of what the regulation or the accounting guidance is out there, just understanding the dynamics of your business are just so critically important. We really take it back to what we are as bankers, as risk managers, and, being really able to fully understand the risks that we're taking at any given moment and realize that they have pervasive impacts, I think is critically important.
Yeah. Now, one last thing I want to bring up is, it wouldn't be a podcast with you, Susan, if we didn't talk CECL. So,
oh, good Lord. Yes, that's true. That's right. CECL, here it comes.
So I was chatting with somebody yesterday, and they made a great point. Back in 2020, the first wave of adopters adopted CECL, and then the pandemic hit. And here we are now with the rest of us adopting CECL. And then these bank failures hit. It's just, I just want to throw that out there.
CECL is the root of all evil. Is that what you're trying to say? Like, don't adopt CECL because something traumatic's going to happen? No.
No. I just thought it was a really interesting parallel. But I guess my question is, do you think this does cause just additional challenge in calibrating those CECL models? I'm certainly not for day one, because this was after 1/1, but for quarter one, for instance.
I guess what I would say about that is inherently CECL is about your credit risk. Right. And so I think what we have to really just remind everybody of is, even in times of turmoil, you just have to, kind of what you were saying about the accounting rules and thinking about the why. We have to be really thoughtful about the why here. And this was not a loan event, right? This was not a loan issue. This was a deposit issue. And that doesn't mean that there aren't some repercussions that somehow end up manifesting themselves, right? If somebody doesn't have access to their funds and they have a loan somewhere else, can they pay or not pay? Those are things that you have to think about. But, I think in most of these cases, those were concentrated in certain places. But so I do think they cause you to think about them, right? And maybe what it causes you to think about is think about your concentrations differently.
Sure. Yeah.
Things like that. And so that kind of goes back to some of those lessons learned that I was saying before. Even if you think something doesn't have anything to do with you, it probably does. Right. And there's lessons that you can learn and be challenging yourselves and thinking about that maybe are related, but not directly to. And so in this case, I don't really see anything immediate relative to CECL. But I do think that anytime you have an event like this, you need to really challenge your thinking. And if you can't do it for yourself, sometimes you're too close, get in a room with some other people and say, what could really go wrong here? And you may find that there's an element that you need to deal with for sure.
Yeah. Well said. Well, we've covered a lot today, unpacked a lot, and rightfully so. There's a lot going on. But anything else you wanted to cover, Susan, or should we wrap this one up?
I think we're good to go for today. Yeah, there's always going to be some more things to talk about. There's never a dull moment in banking. It's definitely never a dull moment.
Yep. Couldn't say it better myself. Well, thank you so much, Susan. It's always a pleasure, and thank you to our listeners too. Thanks for tuning in. And, certainly if there's any questions as a result of this In the Know podcast, reach out to Susan or I. We also have our Ask the Advisor feature on the Very Done website. It's a great resource to reach out as well. We'll look forward to recording and sharing the next one with you guys. Thank you so much.